Welcome back to another episode of me sticking my nose into these charts every single day until I discover a trade model that yields me millions of dollars in the dream life that I've been working towards for the past year and a half now. And in today's session, I didn't do too well. I went 1 for 4, I got 1 observation correct, and 3 incorrect, which is perfect because now I can go back and study exactly where I went wrong, extract those lessons, and become a better trader because of it. So let me just do a brief little overview of the process that I've been doing recently. All this is literally the process that ICT outlined in his 2024 mentorship for his son, where you're simply not pushing any buttons, meaning you're not taking any trades, because as soon as you start taking trades, you add emotions to the equation. And you're not going to focus on reading price action and analyzing what are the candlesticks telling you. You're going to be worried about making money or being right. So the whole point of this is to not take any trades and just observe what you see in price action, and you document that. And if you get the observation right, you mark it right. If you get it wrong, you mark it wrong. In doing this process, I've extracted so many lessons. I've learned so much about myself without losing a single penny, which is why I believe this process is absolutely genius. So, a little brief overview of that, and then here's some metrics that I'm tracking. Obviously, the day that I recorded it, the date, the status, wrong or right, the time I noticed the observation, what side of the market it was on, how long it took to deliver to my objective or stop me out, how fast it took to move in my favor or move against me, how far it moved in my favor, how far it moved against me, and the reason why it didn't work or why it did work. Oh, I forgot to update this one. Whoops. And then we got some statistics down here that can build a basis for what I can expect. So I'm literally recording all this data. I'm learning all these lessons, and I haven't lost a single dollar. Which is why I think there's truth in what ICT says when if you think you have to learn by trading in a live trading environment, that is foolishness. That is stupid. Because I haven't lost a single penny and I have learned so much about myself and the market. So it's crazy. But anyways, today I went 1 for 4. So I'm just going to review those. Maybe talk a little bit about myself because I'm also doing this process as well. I call it control because the whole point of introspection is to master self-control, which is why I love this quote. Are you going into this to control yourself, or are you going to let the ebb and flow of the markets take and give to you, or are you going to let the ebb and flow of what the markets take and give to you dictate how you're going to behave and think? So are you going to control yourself, or are you going to let how the market moves control your thinking and your behavior? So I've also learned a lot about myself simply through watching price action, not even taking any trades, which is why it's stupid to think that you have to trade. Learn how to trade in a live trading environment. Now, eventually, when I get to the point where the amount of observations that I get correct surpasses the amount that I get incorrect, then I'm going to start demo trading. And then once I can prove that I consistently pull a profit demo trading, then I will go into live trading. So I'm literally just submitting to the process. I'm removing the time element from it. I'm not worried about how long it's going to take me. Although I had a big revelation the other day about myself and how subconsciously I really do care about how long it's going to take to make it, but that's for another video. So my first observation was 833. Now, when I came to the market today, I didn't really have many expectations. I knew that we had this weekly volume imbalance above price, or not volume imbalance, inverse fair value gap. So eyes were on that. This is definitely a potential point where we could catch a sell scenario if the market were to trade up there. But coming to the charts at 7 a.m., the start of the New York morning session, I didn't really have any expectations. There wasn't really clean, clear, concise pools of liquidity at the time. And so that's where I recorded my first observation was somewhere down here in this area, because what I was seeing was we had this reaction off the daily volume imbalance. Notice how the candles on the 15-minute chart closed below it. So that is indicative of weakness. Now the market is selling off. And honestly, I got short here, but it was way too late. I was hypothetically selling way too far in a discount, because if you look left, we can see that price ran out these lows right here. And if we drop down to a lower time frame, we can start to see that these lows were down here at the time. The first observation was at 833. So you can see that I was selling short, hypothetically, when the market was trading way into a discount had spent all this time underneath these relative equal lows right here. So the market is sitting in this pool of sell side liquidity. When the market spends time in a pool of liquidity, that indicates that it is going under accumulation. If it spends time there, it is going under accumulation, meaning the market is affording entities the opportunity to get into a trade. And if you look what that produced, it produced this entire price leg right here. This 150 handle run initiated with the accumulation of longs underneath these relative equal lows. And so I was selling short all the way down here when price had already traversed from here to here. It already ran 73 handles before the 930 open, which is a pretty decent price leg. Spent all this time underneath these relative equal lows, and that is when I was looking to get short, like somewhere all the way down here, like 830 or something. So it was just selling way too far on a discount. It didn't make any sense at all, given that price to this. And we see no form of retracement either. If you look in this price leg right here, there's no retracement. It's simply just, it's pretty heavy all the way down. If you look at the order flow, it's bearish. Here we have an institutional order flow entry drill. Order block, hammers the order block. Another order block, doesn't reprice to it. We have a small imbalance here. Trades into that imbalance, makes up another bearish order block. And then here's the terminus of the price move when it starts spending all this time underneath these relative equal lows. So that brings me to lesson number 1 that I learned about today, is you have to study how price is approaching pools of liquidity, because if it's spending time underneath or above a pool of liquidity, then it is going underneath accumulation, and that could indicate a potential reversal in the opposite direction. But if we see price approach a low and accelerate through it with strength, speed, distance, and magnitude, then that indicates we could see some continuation in that move. Like for example, these are also relative equal lows, and this is what I was aiming for in this whole price leg up. So you notice the difference between the reaction to these relative equal lows and these relative equal lows. See how we come down, trade underneath these relative equal lows, and we just hang around. The ranges kind of overlap each other. It's a little bit of back and forth, and then eventually we see a large up close candle. Change in the state of delivery. Now this is a bullish order block. That bullish order block is respected, and this is where we see a reversal. Now compare that to this right here, where we have these relative equal lows, but look, we just absolutely just slice right through it. So if the market were to continue through that pool of liquidity, this is exactly what you would want to see. You wouldn't want to see it just come down, hang around, consolidate, chop around a bit. You don't want to see that, because that's probably indicative of a reversal coming. You want to see it absolutely accelerate through that low and continue through it. This does not give the opportunity for all the sell stops underneath these lows to pull their positions. So the algorithm is going to aggressively drive into these relative equal lows because it is designed to do so. This price action right here is designed to not give those who are in long's position a chance to remove their position. They are trapped, and it just runs them over. Literally, they don't have time. It's just boom, accelerates right into them. And to compare that to this, huge difference. So if I go down to a 1 minute time frame, what I based, I need a little context, but basically what I thought was going to happen was there is a 15-minute buy side imbalance here. So here's the high of it. You can see it right here. So I thought, I'm going to just make this blue. Since we closed below this imbalance right here, I was thinking we would now see it act as resistance. Since we closed below it on a 5 minute. And, was it on a 15? Yeah. And we also had, not that, this premium wick right here. And the premium wick was kind of close, in close proximity to the high of the old buy side imbalance that just got disrespected. So I was thinking price could retrace, use the buy side imbalance high as a premium array, as well as consequent encouragement of the premium wick, and then roll over and trade into this low down here. That's what I was thinking, but obviously I was just selling way too far in a discount when the price has already reached its terminus. And if I look at the lower time frame, it does this. It literally shows my bread and butter long scenario. So that's why this setup is incorrect. We can see that price is running out the relative equal lows on a higher time frame right here, and also on a lower time frame as well. So these relative equal lows formed, it runs that. There's no speed, no distance, no magnitude, no acceleration through those lows. So what does that indicate? Could potentially reverse especially when immediately following that you see a large up close candle, a change in the state of delivery. Now this is a bullish breaker. Notice how the bodies respect that bullish breaker. Change in the state of delivery, inversion fair value gap, hits it, boom, trades higher. So I got my hypothetical entry like somewhere up in here. I was thinking like, in this case, I just hypothetically threw a limit order out there and I would just let it get filled because I'm pretty confident that the market would turn here. Obviously not the case, but it's okay because I learned from it and now I know exactly why it didn't work, which is perfect. So speculating reversal here did not pan out. That's that lesson that I learned there. You got to study how price attacks these pools of liquidity. Does it attack it or does it hang around and just chop, you know? And then that brings me to the second setup. I'll just leave that on there. Which was framed off of this imbalance right here. I'll just mark, actually I'll just borrow this. Give me that. We'll just do this and this. So this setup was framed off of this 15-minute imbalance. Now because this is a 15-minute time frame and I still have not seen a close above this consecutive series of down close candles, I was thinking on the 15-minute time frame I still haven't seen a change in the state of delivery, so price could continue to remain heavy and it could probably roll over and take out these lows because these lows are now relatively equal. That's what I was thinking. But what I should have realized is from the previous trade is that look how much time spent underneath these relative equal lows. I also see a smart money reversal, my bread and butter long scenario, on a 1-minute time frame. And if I go to the 5-minute time frame, I also see a change in the state of delivery on the 5-minute time frame, and now price is respecting bullish fair value gaps on a 5-minute time frame. So things are changing on the lower time frame, on the 1-minute and the 5-minute. Things are changing. The narrative is shifting to back to the buy side. Although in the 15-minute, I never saw a close above those up close candles. So I was thinking we could frame a reversal off of the 15-minute fair value gap, especially when I see the candles close below it. So that's what I was seeing. That's what I was really seeing that really sparked my interest in this potential trade idea. Was a close below it on the 5-minute and the 15-minute. So I thought, okay, the higher time frame is closing below it. Let me see if I can look good short. And we also have an order block right here. So that's what I was thinking. And obviously that did not play out. Now the problem with this setup was a problem that tends to repeat within almost all of my incorrect observations. So from what I've learned, when I'm anticipating a reversal, I need to see an opposing imbalance inverse, meaning if I am looking to short the market, I need to see a buy side imbalance, sell side inefficiency get inversed, which would be this right here. And right away, you can already see why this trade did not work without me even having to explain it. So my hypothetical entry I said was going to be off of this order block right here, because we are rejecting the lower quadrant of the 15-minute sell side imbalance, buy side inefficiency. I see closes below it on a 15-minute time frame. This is where I was looking to get my hypothetical entry on the 1-minute order block. So we tap it, we do reject it, but look what's below, right below. What do we have? We have a fair value gap, and price never closes outside of it. We do wick outside of it, wicks do the damage, that is permissible. It is allowed to color outside of the lines. This wick is literally just reaching into this fair value gap right here. So that's permissible. It's just reaching into a lower PD array. But notice how the bodies never, ever, ever close outside of it. And when I see this, this is a clear indication that that setup is not going to play out. And in hindsight, this is also a bullish breaker. We have a low, a high, a lower low, and a higher high. So if I extend this out in time, price is accumulating inside the fair value gap and the bullish breaker. So 2 reasons why that did not play out here. And another thing that I've outlined is for me to frame a reversal, it has to be off of 2 PD arrays, which I guess you could say would be 1, 2. But I never see the opposing imbalance inverse. And I'm just taking the entry off of the order block. Usually I have some other PD arrays aligning with it. I do have this new week opening gap, which could potentially be used. So the main reason that this did not play out was simply because I need to see an opposing imbalance inverse. Because once I see that, that indicates a change in the state of delivery. Something has changed. The narrative has shifted, and the market is now in a either in a buy program or a sell program, it's switched. And if I go to the 5-minute, it's the same thing. So yeah, we're closing below the 15-minute sell side imbalance, buy side inefficiency, and we're barely wicking into that lower quadrant. But what are we doing here? Nothing ever changes. And because nothing ever changes, it continues to rip higher. So this was just reaccumulation right here. So I learned a little bit about the market maker sell model, how there's 2 stages on each side of the curve, right? I think in a market maker sell model, on the buy side of the curve, you have first and second stage reaccumulation, right? So I think this would be reaccumulation because I saw a smart money reversal down here. I don't know. Don't quote me on that. Still haven't really learned too much about that. But notice how the body's staying in the upper quadrant of the BISI, which is indicative of strength. Wicks into the lower quadrant, permissible, just reaches into this order block, right? And then we did get a reaction here, but never saw this inverse, so it's never valid. And then boom, we trade higher. So that is why that one did not play out. Incorrect. Perfect. Now I know exactly why. And it was literally the same thing that happened on Friday when I was looking to hypothetically short the market again on Friday. It was, I'll literally go back to it right now. It was right here. So I saw price wicking off of, what is this level? The sell side imbalance, buy side inefficiency on a higher time frame, daily chart. So I'm seeing where it's the same, literally the same scenario, right? We're closing below a higher time frame PD array, a pertinent PD array, which I could use to frame a reversal off of. But notice how, what are we doing here? We're working inside the 5-minute BISI, and we're closing inside of it still. We fail to close outside of it. We do reverse this one, but this one we're still respecting clearly. And then we just continue trading higher. We run this high, and that's when the real move of the day came. Well, another thing that I was going to cover about this setup is that it wasn't occurring at the right time. So one thing I've noticed, before the 9:30 open, you usually just see consolidation forming. And that is the start of a market maker model. In this case, it was the start of a market maker sell model. See, here's the original consolidation, and that's why I have this target here. Because I see this, I spot the original consolidation, these relative equal lows. There's this perfect little box of price action right here. And then price trades up higher at the 9:30 open. It's a Judas swing. A reversal can be framed off of the weekly PD array. And then we come back down, run those relative equal lows. So one thing that I've noticed is before the 9:30 open, we usually see a period of accumulation where the market just consolidates, trades sideways. And so between 9 and 9:30 is not necessarily a time that I want to be engaging because this is the price action that it usually shows. And if I go to Friday, it's the same thing. Shit. And here's Friday, right? Here's 9 a.m. to 9:30. It's the same thing. You're just accumulating before the equities open. So 9 to 9:30, not necessarily a time that I want to be looking to engage at all. So I'm learning that lesson without having to lose any money at all, which is perfect. The whole point of this process. So there's that setup. Number 2. Number 3 was 10:06, which was right here. So this whole point, the market is just grinding higher, just keeps grinding up. Notice how we just form these short-term highs. Each time we take out a short-term high, we have a little drop down. We're not seeing any significant price runs, so it just keeps digging up into the weekly inverse fair value gap. So when price trades into this, I need to take a step back a bit. Here was my approach to the 9:30 open. Here's what I saw. So first things first, you have to frame your primary pools of liquidity on the 15-minute time frame because you can frame a narrative off of those. You can frame a narrative for the daily range. So before the 9:30 open, obviously we have these relative equal highs here, and we have these relative equal lows in here, all these in here, relatively equal. So here's my primary sell side, my primary buy side. And then above, we have an inverse fair value gap on the weekly chart. Now, just inside that weekly inverse fair value gap, we have a 15-minute sell side imbalance, buy side inefficiency. So this is definitely a potential area where we could frame a reversal, especially if post 9:30, the first thing that we do is trade higher and run primary buy side liquidity, because the market simply goes from attacks one area of liquidity and then goes to the next. So it simply takes an area of price action that is smooth, which in this case is right here, smooth, makes it jagged, and then attacks the next area of price action that is smooth. So if it runs primary buy side liquidity first, and we know that the first side the marketplace offers to the public is the wrong side, and look what we're trading up into, the weekly inverse fair value gap and a 15-minute sell side imbalance buy side inefficiency, we can use that to frame a reversal to then attack the sell side liquidity down here. So this entire move up, I'm thinking down here the entire time, especially when I see that original consolidation on 1 minute time frame. When I see this and I see this, take this out first, I'm thinking lower the entire time. So I did get my draw on liquidity right. It's just I slightly mistimed the market here, which brings me to another lesson that I learned today. And this is something that ICT revealed on Friday's live stream, where you have to incorporate other PD arrays that are in part of fair value gaps or part of sell side imbalance buy side inefficiencies, because it changes the characteristic of it. And in this case, what do we have resting inside this SIBI? Well, if you look left, we have this old low, which is an up close candle, so that would make it a bearish order block. So we have a bearish order block inside of bearish order block, old low, whatever you want to call it, inside of this 15-minute sell side imbalance buy side inefficiency. So how far can price trade up into this 15-minute SIBI? Well, it can trade up into it to refer to the order block or the old low. I'm not 100% sure if this is a valid bearish order block, but what I've realized from what ICT said on Friday is that when you have a PD array that is inside of, that resides in a sell side imbalance buy side inefficiency or a buy side imbalance sell side inefficiency, you have to incorporate that, because what we usually see is the market dig up into that inefficiency to refer to that PD array, which is exactly what we see here. We see price traverse over the entire SIBI, and it's referring back to this old low. Oh shit. Yeah, look at that, right? So that's what price is doing. Why is it coloring outside the lines? Well, we have a balanced price range here. We also have this, the open price of a bearish order block. So you have to incorporate that inside of your fair value gaps, because that's how far price could trade or reach up into that fair value gap. That was a huge aha moment that I had on Friday, and it works. And if you pair these PD arrays with that inefficiency, then it makes it really, really powerful, like really powerful. Like if you have a breaker inside of a fair value gap. If I go to, where was it? Like right here, on these 2 days right here, it's the same thing. See, we have this inefficiency right here, but we have the breaker, right? We have a high, a low, a higher high, and a lower low. So what are the last down close candles before the turn that makes the stop run? That's a breaker. So the low of the breaker is nested inside of this inefficiency. So how far can it trade up into the inefficiency? Well, it can refer to the breaker. And we also have this large wick. And it's the same thing where? Here. We have this inefficiency right here. Well, how far can it trade up into that inefficiency? Well, if we incorporate the PD arrays that lie within it, we have an order block, which it could reach up to there, which it fails to do so. And we also have this wick. So it could reach up into that. So that's just something that I've learned. So we can expect price to not close in some inefficiencies because we have nested PD arrays within them. Like if we have this breaker inside of this inefficiency, we don't want to see this whole thing close. We want to see it come trade up, reject that breaker, and then roll over. So that's something that I discovered. Now if I review this observation that I got incorrect here. Basically, it was just slightly mistiming the market. And the logic that I just outlined potentially could have helped me time a reversal up here, because the market did actually trade through that entire inefficiency refer to that old low over here, right over here, and that is when it broke down. Now, if I just simply waited for the market to trade up to that, I actually outlined that and wrote it down in my journal, like how far can it trade up into this inefficiency? Well, we have that old low. That's why I had it annotated on my chart, but I wasn't aware of that in the moment. And here's where I got my first hypothetical sell scenario post 930, was when I see this buy side imbalance, sell side inefficiency get inversed, and then we have a change in the state delivery. So if I just annotate this real quick, get out of here. So if I just annotate this real quick, this is inversed, this is a change in the state delivery, and there's a sell side imbalance, buy side inefficiency. So I'm thinking there's a lot of converging factors in this one area. We could probably trade up into here and then go run out all this, and eventually this. That's what I was thinking at the time. Obviously did not play out, which is fine. Every little drop here was simply engineering buy side liquidity. How I viewed this when I stopped out after that trade was these drops were fake and just engineering more buy side liquidity in the form of early retail shorts. So, you know, as soon as we break a high and we just drop a little bit, retail's going to rush to short that. They're going to place their stops above these highs, and then they just come and clean that shit up. And notice how when we have, this is the largest sudden drop that we saw post 930. So when we had that large sudden drop, look at the vacuum that just absolutely destroys everything above this high. All the buy stops above this high are just sucked out of the marketplace in one quick, clean move. So that's how I know they were actually engineering liquidity here, because look how fast and aggressively they took it. And then boom, what did they do after with it? They dumped it, took it the other way. So this was a strong stop run, a clear, obvious stop run that I saw. After the fact, of course, not in real time. I'll get to that point where I can see it in real time. And then we have the real move unfold. And then look how we close below that 15-minute order block. So I could have actually annotated that. But here's why I took a hypothetical sell. Obviously didn't play out because we traded down into this imbalance right here. And then liquidity vacuum just sucked out all the buy stops above that high. Then once I see this, then I'm like, okay, finally this thing cracked. Finally it rolled over. If I go back up to the 15-minute, I can see a close below the 15-minute CIVI. So if the bodies of the candles are closing within the 15-minute CIVI, and then we finally see this large down close candle move out of it, that tells me the narrative. That tells me price is weak because the bodies are tell the narrative and they're respecting it. And then that is when I look for my sell scenario. So here's where I got the correct observation. Based off the logic that I wanted to see this stay open. Now, why would I want to see this stay open? Because we just left that 15-minute imbalance with such speed and acceleration. And once we leave the imbalance, I wouldn't want to see it retraded back to, because every time I see price leave an imbalance and come back to it, that's usually not a good indication that that imbalance is going to hold price and support the narrative. Usually when I see price revisit an imbalance, it inverses it or disrespects it. So once we leave that imbalance, I want price to remain heavy, and I don't want to see this gap traded to. So I want to see this stay open as a breakaway gap. And if price can't even reprice to this inefficiency right here, that would indicate that it's extremely heavy. And then here we have our breaker. We have a high, a low, a higher high, and a lower low. We can see price taps the low of that breaker right here. Never trades back to that 15-minute imbalance. And then we begin to roll over. So at this point, I notice we're trading back into first presentation. I notice price is now respecting up close candles. And even though we just ran out these sell stops, I am confident that price is going to remain heavy and keep rolling over because of this. We just leave this gap open. I don't want to see it traded back too. So I'm anticipating that we remain heavy and go attack these lows down here and these lows down here. So you could say TP1, TP2. And so as soon as I see first presentation inverse right here, I'm thinking of shorting a move back up into it, rejecting it, and then targeting this original consolidation down here. And also notice how we work off consequent encroachment, the daily volume imbalance, and the 5-minute order block. So I also saw the 5-minute order block inside of first presentation. Now we have a change in the state delivery on the 5-minute time frame. And I want to see price trade up back up into the open price of that, reject it, and send it lower. And it does just that. So finally, post 10 a.m., I finally was able to establish a clear narrative. I mean, it delivered what I was looking for the entire time. This was just my opportunity that I had to get on board with it. It was right here. Boom, hammering that 5-minute order block and first presentation. Look how we closed below that. Closed below consequent encroachment, the daily volume imbalance. And then that analogy that I gave, or not the analogy, but the comparison between how you want to see price accelerate into a pool of liquidity versus, you know, kind of just hanging around and moving sideways and all that. Look how we approach these relative equal lows down here. This is a 37 handle move on a 1 minute candle, which is pretty significant. That was probably the largest candle range that we saw in the entire day. So that was how it attacked these relative equal lows. That was literally the largest candle range that we had in the entire day. And that's how it attacked. That's how it approached these lows, which is exactly what I want to see. So if I see price approach these lows like that with that much aggression, then I am definitely confident that we can roll over and continue into the primary sell side liquidity pool that I outlined before the 9:30 open, and then look at the work off of consequent encroachment at the new week opening gap. We reject that. We also have institutional order flow entry drill on the largest down close range in the entire day. That leaves an imbalance. Institutional order flow entry drill. And then from there, we can simply just read price action. We have an up close candle here. Just read the order flow, read the tape, trade up into it. Notice how we can't close above the open price. Look how the body stopped right there. It's perfect. And then we form a propulsion block. We have an up close candle into an up close candle. And look what happens when price returns to that propulsion block. Crazy. Does it propel price lower? Yes, it does. 100%. So here's my propulsion block right here. So here we initially tap into that sell side liquidity pool. Don't necessarily accelerate into it. So this leads to a little retracement into the propulsion block. And then boom, we roll over. Crazy reaction off of that. That was beautiful. Look how it just wicks right into it. Boom, rolls over. When I saw that real time, I was like, yo. It was so fun. Reading price action is so fun, especially when you're learning and you haven't seen these things play out in real time before. And then as soon as you see these unfold before your eyes exactly as you anticipated, it's just like, yo. It's a great feeling. So we accelerate into that pool of liquidity, trade it into the opening range gap, consequent encroachment, and this will probably be the end of the move for me because it's Monday before CPI and PPI. I wouldn't expect much out of today. And if I go back to the 15-minute time frame, there really was no directional move. It was kind of just up, down, which is expected with CPI and PPI later this week. And those are the lessons I learned today. So I got a lot wrong, but I learned a lot because of it. So the days where you get it wrong the most, where you mess up the most, those are the days where you have to go back through and study, because those are the days that you learn the most about yourself and about these candlesticks. So that's it for today. See ya.